Mr. Cordray, I'm hearing a lot of concern about how Dodd-Frank will reduce the credit availability in the housing market because of some of the proposed rules, particularly for a qualified mortgage that increase liability and for the qualified residential mortgage that requires the 20% down payment. What kind of analysis and coordination is being undertaken to understand the impact of the cost and availability of mortgage credit between the interaction of the QM and the QRM proposed rules?
Okay, thank you for asking the question. It's an important question right now. It's one of the issues that's eating up a lot of time and effort at the Bureau, but rightly so. So the issue is that we are required by law, Congress passed the law, we implement it, to write various mortgage rules that will attempt to improve some of the problems that were perceived in the mortgage market that helped lead to the financial meltdown and the resulting recession and crisis. There's no question that that was a problem. And part of the problem was you're regulating part of the mortgage market, but non-banks who were very active in the market were not regulated. That was never going to work as a model. The rule you're asking about in particular, the qualified mortgage rule, has to do with determining that there is an assessment made, responsible assessment of the ability to repay the mortgage before it is made. You would think that might not be necessary. Why should a lending institution have to be told to pay attention to whether the borrower who they're lending money to is going to repay the loan? But in the lead up to the financial crisis, we saw many, many mortgage loans made with no documentation, no assessment of the financial situation, often falsification of that, in part because there was not sufficient oversight and there weren't rules of the road in place that governed the whole market. We are mindful of the fact that part of our charge in the law is that we are supposed to, and we want to, pay attention to access to credit for consumers. It doesn't do anybody any good for us to develop an elaborate set of protections if nobody's going to then lend money to consumers. That doesn't help consumers, and it would be a failure on our part. That's part of the reason why on the qualified mortgage rule, which we are due to finalize by January, we have slowed down a little bit. We put it out for further comment. We have sought more data on which to make judgments. We absolutely don't want to make a judgment that's going to freeze up or further constrict credit in the mortgage market. We've gotten more data, collaborating with FHFA and others, and we're going to use that to make the assessment here. The final thing I would say is we need to keep in mind that the biggest hit to access to credit for consumers and for small businesses and everybody in our economy has been the financial crisis of 2007-2008. It has caused many institutions to fold. It has dried up credit in our local communities. We need to make sure that that does not happen again to the extent we can prevent it. And cleaning up the mortgage market, I think, is critical to making sure that we accomplish that. At the same time, we need to be mindful that people don't go overboard here. We need to be able to give confidence to lenders that they are able to lend, and we need to have a market that can function. We still don't have a very good functioning market today, 4 years after the financial crisis, and it's the crisis that caused that. We need to remember that.
Well, and I appreciate your attention to trying to address these risks that we now understand were serious problems. But again, getting back to the core issue, we don't want to create a further problem in our effort to address the risks. You indicated this in another way. Secretary Geithner recently testified that as we move forward, we must take care not to undermine the housing market, which is showing signs of recovery, but is still weak in many areas. So we do need to address these risks, but we need to do so in a way that doesn't restrict the availability of credit unduly. And I've asked you before to convene a small business advocacy review panel. I'm going to ask you again. It seems to me that to try to minimize the unintended consequences that the CFPB should convene a small business panel to discuss the impact of the proposed rule. And given the potentially significant impact of the qualified mortgage rule in particular on the housing market and the Bureau's recent notice that you're going to step back and take a little more time to look at this, it seems that this will be a perfect opportunity to move ahead and do as I think the statute requires, and initiate a small business advocacy review panel.
So it's a fair point. By the way, I very much agree with the statement you quoted from Secretary Geithner, and I very much agree with your comments on the statement. In terms of the QM rule, the SBREFA panel does not apply to that because it originated with the Fed, not with us. We did, though, hear the concern, And we recently did convene an opportunity where many small providers had the opportunity to give us direct input on the rule, especially for that purpose. We also have the notice and comment period where everybody can comment, and many are doing so. Again, it is our intent that we write this rule carefully, that we be mindful of the fragility of the mortgage market. I also want to say for the record, the 20% down payment that you mentioned, that's not part of our proposal. It's nothing that we have proposed. That would not make sense as some sort of rule that would be, imposed on the mortgage market. That is not going to be part of our proposal. I'm not supposed to speak too much about proposals before we finalize them, but that will not be part of our.
Well, I understand that the Federal Reserve, because the Federal Reserve started the rule, that there's a technical argument that the Small Business Advocacy Review Panel requirement doesn't apply, but it just seems to me that you've got the time, you should take the time, and I don't understand why there is the resistance to going ahead and conducting a Small Business Review Panel.
Yeah. We're not at all sure that we had the time, given the January deadline, to engage in the entire process that normally is. However, what we did was we convened a panel to get the input, because we want to have the input, and we have done that and continue to do that. So I think that we are trying to meet the spirit of that without blowing past the January deadline, which I think would be bad for the mortgage market, because we're trying to resolve some of the regulatory uncertainty here. Congress has imposed the deadline. We take those seriously. We intend to meet it. We consider that's law that binds us. So, and I'm happy to have our staff talk further with your staff about that concern if you'd like.
Thank you.
Okay.
Senator Akaka.